A lot of people have been talking about fashion stocks. Adidas had their great comeback, Nike is still on the decline, but the little brother of Adidas, which no one is talking about, Puma, is trading at the same price of 2004. The stock has massively come down from its highs and of course was also hit by the Trump tariffs. With historically good revenue growth and a current PE ratio of 10, it might look interesting. So let's look into it. They make their money from three things: footwear, apparel and accessoire. And here I think they're more balanced. They're not so heavily focused on the footwear segment. Footwear is a much bigger segment of a Nike brand, for example. Apparel, not so much. So I like overall that Puma has a more widened approach there. Now in exchange, Puma is not the strongest brand. It doesn't have the same brand power as Nike does. That's a factor. You're more diversified, but less brand power. But they're also geographically more diversified. 43% of revenue comes from the Americas. Now that is not all the US, while around 40% of revenue of Nike comes from only North America. So if the tariffs actually eventually hit, it won't hit Puma as hard as the other shoe brands. When you otherwise read about the earnings call, management always sells you the stock in the earnings call. And it is kind of like reading a cult. It's just about elevating our brand. Will lead to success, distinctive brand DNA. We started to build the foundation. It is just on and on and on. That is noise around the stock. That noise you gotta cancel out. You gotta see what are they planning, what is their position. Their position was that their operating margin has been shrinking for many years now. Since 2021, they haven't grown the operating margin. And that leads to stagnating operating income. And they know that. In 2024, we recorded our highest sell ever. However, I'm not satisfied we could not translate our growth into additional profitability. They grew massively until 2021, and they expected this growth to continue, so they put their investments as if they would continue to grow like that. But they didn't, so that hit profitability. So they introducing that fancy thing which managements love to do, cut costs. Their next level program. Decreasing product complexity, improving sourcing efficiency, all of that. They want to shrink the company, make it more efficient. Now the issue is with these theses is always they can quickly backfire because they start costing money at the beginning. Whenever you move stuff in an organization, it costs money. They say that will one time cost 75 million in 2025. That crashes their net income of only 281 million. Now, if you get a permanently lower cost, that is great. They plan to invest all this money that brings up the cost, but the contributions is gonna bring it slightly down. And once these costs are gone, this thing plus more stays. And if that doesn't work, all of these costs for this year have just been there, made the company more complex, money is wasted, nothing changed. Do not invest because of this cost cutting, because they haven't brought that many examples of what they're doing right now. I don't think management has communicated it very well. It's just another, oh, we're gonna cut costs here, 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 and here. So let's ignore the margin for now. Let's assume they're gonna continue to grow at this point. They're gonna keep their current margin. They're not gonna get a lower cost structure. How much are they gonna grow? Ignore Q4, it was very high because the comparable was very, very low. When we look overall, haven't grown since 2023. Before they grew around 13% on average. They're not gonna continue to grow that in my opinion. Even they are guiding for low to mid single digit growth. Can that recover to maybe 10%? Maybe. Now to achieve higher revenue growth, they're planning to increase media spend, aka advertising. Here we're gonna focus on three key markets. The US, of course, biggest consumer market in the planet, but also highly competitive, currently very uncertain due to tariffs. Germany, more stable, but less revenue growth. Puma is known in Germany. They are from here. So they're always going to have a higher market share in comparison to other places. China, difficult. The Chinese are switching more and more to domestic brands. I don't know if Puma in the long term can take the market share away from them. Maybe from Nike, but it's going to be very hard. Puma is currently number 3. Behind Adidas and Nike. Their plan is to just tear a bit away at the others. If I can do that, that's great. Now thinking about this, what am I willing to pay for Puma? And for that, we can know what can we expect to get directly from a company. We're putting around 50 million into buybacks and 90 million into dividends. So we get around 4% return at the moment in buybacks and dividends. Now if we say with a current earnings per share of 1.9, what are our assumptions? Like we said, historically they grew at around 10 to 12% over the last 10 years. But those high growth times are behind. The industry is slowing down, especially the footwear segment. But Puma is not as hard hit there because they have more in apparel. If we're just gonna assume they're gonna grow revenue by 6%, the cost program isn't gonna change anything. 2% of buybacks and a 15 multiple, with 35% of earnings paid out as dividend with a little deduction due to taxes. So it would come to 27 euros a share. That is a 24% discount to where it is today if we require a 10% return. So not at all a bad buy. Now what would be the downsides? Puma is gonna have very slow growth of 4% for the next 10 years. Maybe the tariff's gonna hit them, US dollar is gonna decline, so a lot of the segment there is gonna shrink in euro terms. Only 2% buybacks, stay at the 10 multiple. The downside is not that big, 17.2. That would be around a 6% return. Now what if everything works out well? So basically, as management envisions it, they cut the costs, they increase their market share again, they grow maybe 10%, and after that 13% with 20 multiple. Then we have a double in the stock. The baseline scenario for me is this. When it comes to Adidas, Nike, and Puma, I would rather buy Puma probably. However, I don't like any three of them that much, so I will pass it for now, but it will go on the watch list. What do you think? Write down below. Have a good day.